The paradox at the heart of modern monetary policy. A scenario is unfolding in global financial markets that would have seemed almost impossible to serious economists just a decade ago. The world's most powerful central bank is contemplating interest rate cuts even though inflation remains stubbornly above its own target. The Federal Reserve, which spent 2 years aggressively hiking rates to combat the worst inflation outbreak in 40 years, now finds itself in a difficult position. Economic growth, labor market conditions, and financial stability concerns are pulling the Fed in a very different direction from the simple goal of getting consumer prices back to 2%. This is not a policy failure. It is a reflection of the genuine complexity of the economic environment the Fed is navigating. In this article, we examine the competing pressures bearing down on the Federal Open Market Committee, the scenarios in which rate cuts happen regardless of elevated inflation, and crucially, what each of those scenarios means for equity investors, bondholders, real estate owners, and anyone with savings sitting in a high-yield account. Why would the Fed cut rates while inflation is still high? The Federal Reserve has a dual mandate: price stability and maximum employment. When these two objectives pull in opposite directions, as they do today, the Fed must make judgment calls that will inevitably disappoint someone. The case for cutting rates despite above-target inflation rests on several pillars. First, the current level of real interest rates, that is, nominal rates adjusted for inflation, is exceptionally high by historical standards. There is growing evidence that this tightness is beginning to slow economic activity in ways that could ultimately threaten the employment side of the mandate. Second, inflation itself, while still elevated, has a different structure than it did at its 2022 peak. Much of the remaining inflation is concentrated in the service sector, particularly shelter costs, which are notoriously slow to respond to monetary policy. The Fed cannot fix a housing supply shortage by keeping rates high. In fact, by making mortgages more expensive, it slows new construction and paradoxically makes the supply problem worse. This has led influential FOMC members to argue that the marginal benefit of holding rates at restrictive levels is diminishing, while the cost to the economy is growing. The global dimension, dollar strength, and its discontents. The Fed sets policy for the United States, but its decisions reverberate through every corner of the global financial system. The U.S. dollar remains the world's reserve currency. When the Fed keeps rates high relative to the rest of the world, capital flows into dollar-denominated assets, pushing up the value of the greenback. A strong dollar is, paradoxically, one of the mechanisms through which American monetary tightening exports deflationary pressure to the rest of the world. Cheaper imports hold down U.S. inflation, but they simultaneously devastate the economies of emerging markets burdened with dollar-denominated debt. Therefore, the pressure to cut rates is not purely domestic. Trading partners, multilateral institutions like the IMF, and even some of America's closest allies have signaled that prolonged dollar strength is creating instability in their own economies. While the Fed does not set policy based on international politics, it is acutely aware that a global financial crisis triggered by dollar funding stress would ultimately circle back and hit the American economy. This geopolitical dimension adds another layer of pressure toward easing. 3 scenarios. What the Fed might do next. In Scenario 1, the Fed cuts aggressively in the second half of 2026, prioritizing growth over its inflation target. In this case, equity markets, particularly growth-oriented technology and consumer sectors, would likely rally sharply as cheaper money reduces the discount rate applied to future earnings. The dollar would weaken, boosting returns on international stocks for U.S. investors. In Scenario 2, the Fed executes a slow, shallow cutting cycle, 25 basis points at a time over 12 to 18 months, while keeping real rates in modestly restrictive territory. This soft landing scenario is the Fed's preferred narrative. If achieved, it would represent a genuinely impressive piece of monetary policy management. In Scenario 3, the Fed is forced to hold rates higher for longer because inflation proves more persistent than expected. This stagflationary outcome, low growth, high inflation, and high rates, is the most damaging for financial assets. In this environment, cash and short-duration instruments become relative safe havens, along with real assets like commodities, real estate, and gold. What this means for your investments. For equity investors, the key question is not whether the Fed cuts, but why it cuts. Rate cuts driven by a softening economy are fundamentally different from cuts made in a healthy growth environment. History shows that in recessionary cutting cycles, equity markets typically fall significantly before they recover. In contrast, insurance cuts, made to extend an ongoing expansion, like those seen in 1995 and 1998, have historically been followed by strong market performance. For bond investors, long-duration treasuries are attractive because prices rise as yields fall. For savers, the message is clear. The era of 5% plus risk-free returns is likely drawing to a close. These yields will follow the Fed funds rate lower, and idle cash will gradually become less rewarding. Practical portfolio adjustments for the rate uncertainty era. Given the range of possible outcomes, a barbell approach makes strategic sense. On one end, maintain exposure to assets that benefit from continued higher rates, such as short-duration bonds and dividend-paying equities with strong balance sheets. On the other end, begin building positions in assets that would benefit most from a cutting cycle, such as long-duration bonds for capital appreciation and interest-rate-sensitive real estate investment trusts, or REITs. The middle of the barbell, and the riskiest ground in this environment, is low-quality credit, highly leveraged businesses, and speculative assets with no current earnings. For risk-conscious investors, reducing exposure in these areas is the most prudent move. Conclusion: uncertainty is not the enemy. Unpreparedness is the Federal Reserve's next move is genuinely uncertain. The Fed is navigating a policy environment with no clean historical precedent, balancing an inflation problem that hasn't fully resolved itself against growth and stability concerns that are becoming increasingly hard to ignore. What investors can do is prepare for multiple scenarios rather than betting everything on a single outcome. In this environment, diversification is not just a cliché. It is a genuine risk management imperative. Keep your portfolio flexible, stay informed about FOMC communications, and resist the temptation to make concentrated bets on a single rate scenario. The investors who navigate this period best will not be those who called the Fed's timing perfectly, but those who built portfolios capable of performing across a range of outcomes.